Good morning.
Good morning.
Get your
Good
spirit
morning.
fingers ready, Evan.
Thanks for reminding me. I'm all spirited out.
Welcome to episode 10 of the Home Front. We are bringing back
welcome.
Brian Campbell to chat this morning about why you should why you should own versus renting. I'll let Evan introduce himself.
I'm Evan, realtor extraordinaire at Waters International Realty here in the Austin area. That's pretty much it. I do like long walks on the beach and reading books. So if you guys have been following me on Facebook, you've been noticing I've been waking up at 4 every morning, still going strong.
Yeah.
On my second cup of coffee. And Krista joined the club as well too.
4 a.m. I can't say I've been consistent, but I've been getting up.
Got it.
So, and none other, Brian Campbell, lender extraordinaire.
Hi guys, Brian Campbell, Supreme Lending. Good morning.
Good morning.
Please share this out. Hello, Valentine.
Share the screen.
I'm
going to share it right now.
Own one day. Yes, please share it out. Thank you for joining us this morning. We're going to talk about why you should own versus renting and kind of break down a couple of scenarios on payments. So did you have a scenario picked out that you wanted to?
Yeah, we did you guys, we had a few different scenarios that I had created yesterday. So one thing that we put together is kind of like if you're renting right now and getting an idea of what, if you bought a mortgage, what the payment would be like compared to what you're renting for. So we ran a few scenarios, and the first one that we did was based on a purchase price of around $180,000.
Okay.
And I know a couple weeks ago we talked about different types of loan programs and things like that. On these scenarios, just keep in mind that these are based upon FHA loans with 3.5% down. So, there's also a conventional mortgage, and they're both fine for first-time home buyers. The conventional mortgage is actually, if you're a first-time home buyer, you can do with a 3% down. And some factors that we determine when we're pre-qualifying you is, which one will work best for you is if, it depends on your credit and your debt to income ratios and things like that. So for simplicity on this, we did this for FHA loans. So for instance, if you are paying around $1,500 a month in rent, which is pretty average now, are you guys finding that they're in the $1,300 to $1,500 range? Is that kind of what you're seeing?
Yeah, I'd say when I talk to people about their monthly payment, I ask them where they want to be, and they say usually under $1,200.
Right.
So I tell them they're going to be around $1,500 to $1,700 a month. And along that goes, some of the things that go into your mortgage payment are going to be your payment or your principal, interest, taxes, and insurance. So I also like to run mortgage scenarios with different houses because it gives them an idea. Even though you may be purchasing more, your payment may be low because you have a lower tax rate.
Cool.
So a lot of those things are important.
Right. So Krista's, what she's talking about, what makes up the mortgage payment is your principal, interest, taxes, and insurance. Another thing, if you're putting less than 20% down, in most cases, is you're going to have what they call PMI or private mortgage insurance. So if you're online and you're just kind of shopping around, and a lot of times you'll see estimated payments through different websites for a mortgage. A lot of those are not actually accurate because they're only showing the principal and interest, and they're not including the taxes and insurance. Or keep in mind that if you're putting less than 20% down for your scenario, that you might figure out principal, interest, taxes, and insurance, but you're not calculating in the PMI. And that PMI could be on a $180,000 property, could be, depending on what you put down, could be minimal, or it could be a couple $100 extra a month in your payment. So it's always advisable to talk to a mortgage professional to kind of determine, what your scenario is, how much you're putting down, and then be able to figure out what that PMI might be. Okay? So in this scenario, we're looking at a $180,000 property.
Okay.
Putting 3.5% down.
Okay.
If your rent was $1,500, you're coming in a little over $1,500 a month on your mortgage payment, and that includes mortgage insurance as well.
Okay.
So the idea is that you can buy a house for $180,000 and almost get, depending on property taxes, similar to what you're paying in rent, if not less. If you have a situation where you can put down 10% or maybe 20% down on a property, then you may have a payment substantially lower than what you're paying in rent. So it's all something to talk to your mortgage professional about and figure out what assets you have. If you need down payment assistance, let's kind of figure out what your overall payment would be. We looked at one for closer to the 190 mark, and that was just under $1,600. And kind of the rule of thumb that I always talk about is for every $5K difference in your purchase price or your down payment, your payment's changing about $25 a month. So it's not real substantial. Now, if you're putting down more money, though, let's say you rather than putting down 3.5%, you're putting down 10%, then that PMI is going to lower in most cases, and that'll change your payment more than that $25. So, but if you're looking at, let's say we talk about a house for $180,000, and I say that the payment, depending on taxes, will be about $1,500 a month. If you say, okay, what if I went to $190 on my purchase price? Then that's going to change your payment by about $50 in that ballpark range, $50, $60 depending on the purchase price. So, you can kind of do a rough estimate of if I had a house for $180 and I know it would be about $1,500. So if we went to $210, right, which is what, $30,000 more.
Mm-hmm.
Mm-hmm.
If we're doing 50 per 10,000, then you're going to have about $150 difference in payment. And obviously there's increase in property taxes and things like that. So these are just really rough estimates. But $10,000 doesn't change your payment a whole lot, maybe $50, $60. So,
Wow.
yeah.
Yeah, and I'd say the big factor, which people just don't realize, is that the tax rate is a big deal, and the HOA. Because you can get a condo that's less expensive and has a huge condo payment every month, and that's going to factor into your affordability. But like he said, there's a lot of variables in the mortgage payment. So running scenarios when you actually start looking is a good idea if you're trying to keep a mortgage payment within a certain amount. Now, you talked about PMI, Brian. Can we dig into that a little bit?
Yeah, so PMI, when you're putting down less than 20%, you're typically having PMI unless you're doing a VA loan. And PMI is insurance that is required that's basically kind of protecting the lender's piece of it because there's less equity in the property. So I think they think it's like a higher chance of default on the loan if you've got less money into it. They want a little bit of insurance. That way, if something happens with the borrower, the lender's protected if the property goes into default. So PMI is really dependent upon, on FHA loans it's pretty standard, but it depends on how much money you're putting down. On conventional loans, it can be quite a bit different because it's based on your credit score. And so if you've got a 800 credit score and you're putting 5% down, your PMI is going to be a lot lower than if you have a 630 credit score and you're putting 5% down. It could be a big difference. So there's no real way to calculate your PMI without really talking to a lender and letting them look at your credit and looking at your scenario. So it can vary, but I think the important piece is that you want to get an idea of what that PMI will be so you're more aware of what your estimated payment will be. You may qualify for a lot more than you really want your payment to be overall, right? That's something we do all the time. I don't necessarily say, what purchase price range are you looking for? A lot of times I say, what do you want your maximum payment to be? And then we kind of go from there. And so the other thing I'll say is that, the important piece of getting pre-qualified, even if you're 3 or 4 months out, is if you're shopping for properties. I run scenarios all day. I think, Evan, you sent me one the other day with about 5 different houses that I'm running estimated payments on, and then the borrower was deciding on those payments which houses they wanted to go see. So that kind of helps out if, hey, my payment will be $1,900 here or $1,600 here a month. They may want to go see the lower because that's going to be more in their payment range. So
Got it. Brian, you mentioned a couple of times about like rates for the viewers out there.
Right.
What are rates? We're dealing with a lot of first-time home buyers. Can you just kind of explain
so
rates to
viewers?
Viewers?
Interest rates are based upon kind of what the market's doing. They're based upon the borrower's credit score, and we're really until you find a property that you're under contract on, we don't really lock in the rate until that point. So if it's like a new construction home, and you're 6 or 7 months out, you're probably not locking in your rate. There's some programs that allow you to do that, but you're paying a premium to be able to do that. But for the most part, you're waiting until you get a contract until you're locking in your interest rate. When you do get a contract in, a lot of people ask about locking versus not locking, which is floating the rate. And that's another thing, you can, when you get a contract in hand, rates are this, but if the market's doing good and your lender is telling you, hey, we see some potential for improvement, then you may want to, wait until a little bit later into the process to lock until you're getting advised to do so. We at Supreme have a rate renegotiation policy, which is awesome. So if you lock in your rate at one rate, and then during the process of the loan, if the rate gets better, we can go in and renegotiate that rate to a lower rate. So, but yeah, rates are kind of dependent on what's going on in the market every day, and you can lock when you get a contract. You can float it out. Again, something to talk about with your mortgage loan officer to kind of advise you what to do at that point.
One quick question we had, a viewer question, which is, what about rates for your primary versus being an investor?
Yeah, so there's what they call loan level price adjustments. Every investor has for different types of loan scenarios. So on a primary home, your rate's going to be different than it's going to be on an investment. On investment, your rate is going to be dependent upon how much money you put down. Same with a primary. So regular rates right now on primary homes, depending on your credit, are averaging in the 4s. On investments, your rates are going to be in the 5s. You can always, one thing to consider is when you're looking at rates and looking at different lenders and things like that shopping, you might see lower rates with some companies, but you want to make sure you're looking at what they call the cost or the points to get that rate. So for instance, I might be offering you a 4.5 and I have just regular costs, processing, underwriting, things like that. But another lender that you're shopping, seeing online or whatever else may offer, maybe showing a 4.25 rate. Just read the fine print or get a cost worksheet from them, because they may be charging points, which a lot of times they are. If you're seeing rates that are a lot lower than other companies, you got to look at the costs that are associated with that interest rate that they're offering, and which is what they call points, and it may or may not make sense to pay those points. So let's say you're going to be in a house for 5 years, right? And I'm offering you a 4.5% rate, but another lender's offering you 4.25%, but their costs are $3,000 more to get that interest rate. Well, you're never really going to live in the house long enough to make up, to recoup those closing costs. And so, it's not about just quoting rates. It's what we really try to do is really explain to the borrower, hey, here's what the costs are for your loan. Here's what points you can pay. What's your financial goal here? How long are you going to be in the house? Does it make sense for you to pay this much more money to save $30 a month? And a lot of times it doesn't. And you really have to break that down, because some people are just focused on the rate and it may not make sense for them. They may never recoup that money, and it just doesn't make financial sense. So, somebody to break that down for you give you different scenarios is what you're really looking for when you're buying a house. This is a major purchase. It's not just about, I got a little bit lower of a rate.
No, absolutely. I tell you, we get people all the time who are looking at rates, and especially if you have good credit and you have money to put down, they're definitely rate shoppers. We did get a question from Valentine. He said, do you buy points down, which is pretty much exactly what you were talking about. Yeah,
exactly. And what kind of a simple way to figure it out is if your lender is, let's just use an example. Your lender's giving you options for points versus no points. So let's say that there's a rate of 4.5 being offered with no points, and then 4.25 it's costing you an extra $1,800. Okay, that's points. They're charging you whatever it may be. So you take the difference in your monthly payment which let's say in this scenario is $22 or $24 a month. You take that $1,800 and divide it by 24. You guys got a calculator?
Yeah.
So take 1,800 and divide it by 24.
Let me do it. 75.
So 75 divided by 12.
6.25.
So that's 6.25 years it's going to take you to recoup that extra $1,800 you spent to save $24 a month. If you're only going to be in the house for 6 or 7 years, then it probably didn't make sense to pay that extra $1,800. So whatever the difference is in your monthly payment from one rate to the next, divided by the cost of the points or the points or the cost, is how you figure that up. And again, I've seen people that came to me that were going to be, they're only going to be in the house for 3 years, and then they were transferring or doing something else, or their kids were, graduating or whatever, they were going to move on. And they were like, wow, we were about to spend money that we would have never recouped, because even though we were saving $50 a month, we had to pay all this money up front to get there. So you always want to talk to somebody that's going to, talk to you about what your financial goals are, just not what the rate is at that time.
No, that's very good points. I have a lot of notes from this morning. I like to take notes because we don't know everything. We're the realtors, not the loan officers.
That is correct. So the reason why, and I know we didn't start off the show with this, but the reason why we do this show, guys, is to give you guys the information, the correct information. There's so much stuff online. We just want to give you guys our perspective. We're realtors. We got the loan officer in-house, Brian Campbell, that's just giving you guys the tools that you guys need. So whenever your time frame is, it could be now, or sometimes it could be years out for some people. But we just want to make sure you guys are ready and you do have the correct information.
Yeah, absolutely, because like you said, there's a lot of information out there, and a lot of people think that they know what to do, and they're myths. So we want to make sure that you have the right information and you can be prepared. This is a great flyer Brian has. It is loan pre-qualification, which if you'd like it, please hit us up in the direct messages or ask us, and we can forward it over to you. This is a great little tool that you can use to help with some tips. I like the tips on here is to save all your pay stubs during your transaction, saving and submitting all your bank statements, continuing to pay your bills, loans, and debts on time. Don't get any lates, and call your lender with questions. I always tell people, once you get under contract or you're maybe 2 months out, you need to make sure that you don't do any large cash transfers. Hold on to everything and ask your loan officer for permission, basically. I know it stinks, but it's the safest way for you to save yourself during the loan process.
Well, I mean, since you brought that up, Chris, we might as well go over the do's and the don'ts of
Okay.
of what to do. So the main thing you guys don't want to do during this process is do not change your job. Do not quit your job. Either the day before closing, because of your credit, and everything will get checked. It will get checked up until the hour that you guys do sign the papers. So don't do that.
Yeah, I like that one. And don't change bank accounts because you're submitting bank statements. They're going to ask questions. Don't co-sign on any loans. Don't apply for new credit cards, and don't make any cash deposits. They do question cash deposits. I don't know if it's under a certain amount, but I always hear large cash deposits need to be justified, which means you need to write a letter of explanation.
Well, and just to elaborate on that a little bit, so these are things that, again, getting pre-qualified are important. You can always call your loan officer during the initial, when you're looking for properties and things like that. If you are changing a job, call your loan officer, because it may or may not, you may or may not be qualified if you change your job. It doesn't say you can't do it, but you want to just get some advice on what's going on. If you're going to another salary position or whatever, that's fine. But if you're going to an overtime or commission or bonus job, that could affect you being qualified. Talking about changing bank accounts, a lot of times we're asking for your bank statements. If you change over in the middle of getting qualified or during the middle of a transaction, it could be an issue getting statements and stuff to source your money. Obviously, co-sign on any loans. You're responsible for that payment, so you don't want that may affect your debt to income ratio. Applying for new credit cards, that could affect your debt to income ratios, or it could also drop your credit because you're doing a hard inquiry, you're getting new credit. It could drop you from qualifying to not qualifying depending on your credit scores, or it could change your rate. You got a 760 and you got a great rate, you drop down to a 720, it could affect your overall payment because of your interest rate. And then as far as cash deposits go, we have to source all funds, so cash is not something that lenders can use. So lots of different things to consider. Again, just have a relationship with a lending professional. No matter how far out you may be, there's a lot of things you can talk about with them. If you're a year out, you can talk to them about what to prepare for, what to do and not to do. And that way, when you do get a property, you're in the best position you can be in to make it easy for you and also get the best deal overall. So
now, Brian, one thing I want to ask you, you said a couple times is sourcing your money. What does that mean?
So sourcing your assets, it means that we have to prove where your funds are coming from. So the government has strict regulations, the investors have strict regulations. If you got money that's been sitting in your what they call mattress money, it's been sitting in a safe at your house or in your wherever you put your money. If that goes into your bank account, we're going to ask for typically 60 days bank statements. If we see a large cash deposit go into your bank account, that won't work most of the time. We have to show where that money came from, and it can't be, Aunt Hilda gave me a Easter present 6 years ago. It has to be where it comes. If you sell something, if you're selling like you have an Aunt Hilda?
No.
If you're selling like a boat or whatever you're selling, a lawnmower or whatever it may be, that you have to, you need to get a check for that. You need to get a bill of sale. You need to get the contact person for the person that's giving that to you. It can't just be some random, I sold a Pontiac Fiero for $3,800 and it was cash. We can't use that kind of stuff. So you can do gift funds, but just keep in mind that the gifter is going to have to sign a gift letter. And on some types of loans, we have to see that donor's bank statement. Some loans we don't, but most of the time we're going to have to see that donor's bank statement to show where that money came from.
Got it. So what's a gift really quick for the audience?
What's that?
What's a gift?
A gift can be money that you can get on a primary home. You can get money from a family member or a close relative for your down payment and your closing costs. They can gift you everything but it can't be, I'm giving this to you, you're going to pay me back on June 15th. It's a gift. And this is not, gift when we talk about IRS and, the gift limits and all that stuff. It can be for however much. Now, the gifter may, want to only give you a certain amount because of tax implications, but you can get a gift for down payment on most types of loans, except for investments and some second home purchases. So.
It's great information.
Yeah.
A lot of information.
Gosh.
Yeah, so thank you guys again for joining us. If you have any more questions, feel free to send us a message or give us a call. We do this every week for you guys to help you become prepared for your home purchase. This is Evan, Realtor Extraordinaire. I'm Krista. We're both with Waters International, and Brian from Supreme Lending, Senior Loan Officer. Senior Loan Officer. So
I'm old.
Yeah.
Thank you guys again. Please share this out, and we will see you next Wednesday.
Next Wednesday.
Thanks, guys.